don't redeem ELSS investments right after the 3 years lock-in. Many people keep adding a new ELSS fund every 1 or 2 years. They just check which fund has given the highest return in the previous year and then they invest in that fund. A portfolio review is not only about looking at underperforming funds. Ensure you do not have too many funds in the same category. Check if your funds complement each other. Some investors believe that a low NAV means a bargain and it will give better returns, but that's not true. अच्छे वक्त में सभी हीरो होते हैं, बुरे वक्त में कौन जीरो नहीं बना, that's more important. Most investors invest in ELSS funds in the January to March period. Certainly not the right way to go about it. Another mistake people make is to opt for the dividend plan. Hello people, I am Suraj Deo and welcome back to Deo Talks. In today's video, we will discuss the 7 common mistakes that most people make while investing in an ELSS fund or any other mutual fund. Each of these 7 points is equally important, so let us understand them one by one. Number 1. Don't redeem ELSS investments right after the 3 years lock-in. Common mistake is that investors tend to sell their ELSS mutual fund as soon as the lock-in period ends. But remember, the lock-in is just for tax benefits. You can stay invested in ELSS funds for as long as you want. Holding them longer lets your money grow through compounding. This is the safest way to make money from equity investments. In fact, I believe ELSS funds have a strong plus point over other diversified equity funds because the minimum 3 years lock-in gives the fund manager more freedom to focus on longer term investment approach. So ELSS fund managers will not have to worry about investors taking their money out early through redemptions, and they can invest with a long-term perspective. Number 2. Don't hold too many ELSS mutual funds. Many people keep adding a new ELSS fund every 1 or 2 years. Generally, they just check which fund has given the highest return in the previous year and then they invest in that fund. But think about it, mutual funds are already diversified. Having too many ELSS funds makes them difficult to manage and monitor. So what's the advice? Just keep a maximum of 2 funds. Here's why. When you invest in ELSS or any mutual fund, it's crucial to track the performance. You need to benchmark with the indices and you need to check the portfolio holdings of the ELSS. And you also need to check that the expense ratio is under control. All of these take time. Tracking the performance of 1 or 2 ELSS funds is doable. However, if you hold 5 or 6 ELSS funds and you do not have the time and resources to track these funds, then the entire purpose of investment gets defeated. Number 3. Not reviewing your ELSS funds regularly. Yet another common mistake investors make is that they don't review their mutual funds regularly, such as 3 or 6 months. Let me give you one example. There's one ELSS fund called Aditya Birla ELSS Tax Relief 96. It was doing quite well after its launch in 2013. However, it has consistently underperformed its benchmark and peers in recent years. I know many people who are stuck in this fund. They could have stopped their SIPs earlier in 2021 or 2022 had they reviewed their portfolio in time, and then they would have slightly better portfolio returns. Also remember, a portfolio review is not only about looking at underperforming funds. You can check for exposure to different asset classes when reviewing your portfolio. Ensure you do not have too many funds in the same category, such as large cap category funds, as these funds may hold similar stocks, so will limit your diversification. You should also check if your funds complement each other. For example, you can combine a large cap ELSS with a small cap ELSS to balance risk and return potential. One small request before we move further. If you have found this information useful so far, please like this video and subscribe to our community. Your support means a lot. Number 4. Misconception about investing in NFOs. In a new fund offer or an NFO, a mutual fund house raises money from investors for that new fund. Think of an NFO as an IPO for mutual funds, offering units instead of shares. NFOs launch with a low net asset value or NAV, often around ₹10. Some investors believe that a low NAV means a bargain and it will give better returns, but that's not true. First, one should avoid investing in NFOs as these funds don't have a history or proven track record. It's always better to go with a fund that has proved its worth across market phases. Second, please do not think that a low NAV means a cheap fund. The NAV alone doesn't directly indicate whether a fund is overpriced or underpriced. NAV simply reflects the current value of the fund's underlying assets. You should not compare a low NAV of a fund with a high NAV of another fund and think that there is a potential for the NAV to increase. Remember, it's not about the NAV figure, but rather the change in NAV that affects your returns over time. Number 5. Don't pick ELSS mutual funds basis their past performance only. Consistency matters more in the long run. So don't chase top performance basis the past 3 or 5 years. Look at how the fund has performed over longer periods such as 8 or 10 years. See how the fund has performed during both bullish and bearish market phases. Checking performance during different market phases is very important. It helps you in estimating the capability of the fund management under different market conditions. अच्छे वक्त में सभी हीरो होते हैं, बुरे वक्त में कौन जीरो नहीं बना, that's more important. Number 6. Ignoring the merits of the SIP approach to investing. It is often seen that most investors invest in ELSS funds in the January to March period, which is popularly known as the tax saving season, and they invest a lump sum amount in this period to cover their ATC limit. That is certainly not the right way to go about it, and the more prudent approach is to invest every month using SIP route. This approach not only disciplines your investing but also helps in the rupee cost averaging of your purchase, which is one of the secrets for generating long-term wealth, especially in volatile markets. Now, what is rupee cost averaging? Suppose you have 12,000 to invest. Instead of investing it all at once, you break it down and invest a smaller amount. Example, 1,000 every month for 12 months. During this time, the market price of the investment will fluctuate. When prices are high, you will get less units, and when prices are low, you will get more units from that same 1,000 SIP. So by averaging your purchase price over time, you are not that much affected by market fluctuations. So instead of waiting until the end of the financial year and making a lump sum investment, you should start an ELSS SIP at the beginning of the financial year, such as April or May. Number 7. Opting for the dividend plans. Another mistake people make in mutual fund investing is to opt for the dividend plan. When you choose the dividend option, the fund pays out a portion of its profits in the form of dividend, reducing the net asset value per unit of that ELSS fund. Essentially, you receive regular payouts but at the cost of NAV reduction. However, it's important to note that these payouts are not really dividends. What you get here is a part of your capital and a part of your returns back. So if you are investing in ELSS for the long term, do not go for the dividend option. Dividends are good if you want regular income. But if your goal is wealth creation, you should always opt for the growth plans, wherein the profits earned by the fund are reinvested, leading to their NAV growth. That's all for now. Please feel free to leave any question or comments below. Thanks a lot for your time, and let's take care of this beautiful world. I'll see you next. And smile, always smile.